What's up everyone, welcome to Stockton. It's a pleasure to meet all of you. On this channel, we talk about stocks before they start blowing up, say goodbye to chasing stocks at all-time highs, and say hello to making some money. So if this sounds like something you want to take advantage of, then hit that beautiful subscribe button and like the video. Now let's get to it. Before we get into the video, I have to say that I'm not a financial advisor. Anything I say is just my opinion and is for entertainment purposes only. Having said that, if I'm talking about a company, I'll let you know whether I'm personally going to invest in it or not towards the end of the video. But you should always do your own due diligence, so with that out of the way, let's get started.
There is no doubt that Robinhood has changed the game through their zero commissions business model. According to the company, nearly half of all new brokerage accounts between 2016 to 2021 were opened at Robinhood, which is really impressive. So then why should you not buy Robinhood at IPO? Well, there are a few reasons. The first problem is to do with the quality of its revenue and whether it's going to be sustainable. Most of Robinhood's revenue comes from directing customer trades to trading firms that execute the trades and profit off the spread between the bid and the ask. This is known as payment for order flow. However, there is one big drawback with this business model, which is sustainability. You see, when trading activities are at a peak, payment for order flow will rise. But when trading slows down, so does the payment for order flow. So Robinhood's revenue is at the mercy of trading activity, which isn't the best. This is why most brokers rely on other revenue streams for the majority of their revenue instead of payment for order flow. Then there is also the fact that the SEC has recently raised concerns over the payment for order flow business model, so we don't exactly know what is going to happen there and whether Robinhood will need to change their business model. This is a risk factor to consider. Robinhood also heavily relies on crypto trading, which is another area of concern for the SEC right now. According to the company, Dogecoin trading made about 6% of the company's revenue in the first quarter. We all know that crypto trading is cyclical, so this 6% revenue from Dogecoin isn't going to be sustainable either. In order for Robinhood to succeed in the long term, they might need to change their business model. However, that's easier said than done because Robinhood in the past has tried to pivot to different business models but has failed each time in dramatic fashion, which doesn't necessarily boost my confidence in the company. In 2018, they had to withdraw their plans to offer checking and savings accounts after being called out for misleading marketing. They also backtracked on their plans of offering trading in the UK. Overall, Robinhood is a long way away before I can consider it being a good investment. But that's just my opinion, and I'm not a financial advisor, so you should always do your own due diligence. It's likely that Robinhood will have a rally up on the IPO day, but even if you're interested in investing in Robinhood, it might be a good idea to wait and let things cool down before you jump in. Robinhood is likely to have a run-up followed by a big retracement, so you don't want to be stuck buying the shares at the top. So keep that in mind if you do decide to put your money in there. Anyways guys, that's it for today's video. I hope you have a great one and I'll see you in the next one.